Welcome back. We're following the latest move from the Federal Reserve. The central bank cutting its benchmark interest rate by a quarter point, lowering it to 3.75 to 4% range. It's the lowest it's been in about 3 years. But because of the government shutdown, officials were forced to make this major decision without key economic data. And joining us now, Justin Wolfers, professor of economics and public policy at the University of Michigan. Always good to have you here. So what's your initial takeaway from this decision? What's the short-term and long-term impact?
Yeah, there was actually two things that happened yesterday, and it's a complicated story, so let's try and simplify. The Fed announced that they were cutting interest rates by about a quarter of a percentage point. So that sounds like they're taking their foot off the brake. I think that's the better way of putting it, rather than putting the foot on the gas, because interest rates are still at a reasonably high level. That's the first thing that happened. The second thing that happened is half an hour later, Fed Chair Jay Powell came out and gave a press conference in which everyone on Wall Street had expected that the Fed's next move would be another rate cut in December. Well, Jay Powell was very clear. That's not a sure thing. In fact, it's very much up for debate. And so in some sense, what that is a rise in future expected interest rates. So overall, it's neither foot on the brake nor foot on the gas. It's really, let's try and get this machine in neutral, and then we'll coast a while until we figure out what happens next.
It was kind of interesting. It wasn't a unanimous decision. It was the Trump pick, who's a new member of this board, who said he wanted to lower even more. And yet you had another person saying he wanted to hit pause and not do anything. And you mentioned what could come now in December. So given all those dynamics, what will you be watching for moving forward?
Well, one thing, Powell. Goodness gracious. Powell sounded less confident that it was a unanimous board, or even that they were all moving in the same direction, than I've ever heard him before. So, yes, there's the dissent from Stephen Moran. He's the White House appointee who seems to be carrying the president's water. Don't read too much into that. But what you saw on the other side is Schmidt, who's a more serious guy, saying that he didn't want to cut rates at all. And then at the press conference, Powell really was saying people aren't quite sure what they want to do next. There's a funny concept in economics. Let's just get a little bit of a lesson in. It's called R star. That sounds very arcane. What is R star? It's basically, where do we want to get the interest rate for it just to be in neutral, neither foot on the brake nor on the gas? And some of the Fed board members think we're already there. And given that, that's their reluctance to cut any further. So it's not about the outlook for the economy. It's about where are we right now in terms of what a neutral interest rate would be.
And so to that point, how do these rate cuts impact, or rather reflect, the current labor market?
Yeah, so that's what's so difficult right now. Well, so much is so difficult right now. So on the one hand, we've got unemployment clearly trending up. It's a percentage point higher than it was a couple of years ago. It's been one of those things where it's moved so slowly that very few people actually noticed, but the trend now is abundantly clear. And then on the other hand, we've got inflation still at 3%, which is above the Fed's 2% target. And arguably, it's still got a little bit of, quite a bit of tariff still to come, which could push it even higher. So those two factors push in different directions. If you're worried about the labour market, you would cut rates. If you're worried about inflation, you would raise rates. And then you've got one more worry, which is we're about to steer through fog because we're in the middle of a shutdown and we don't actually know where the economy is. All of those things say, when you're driving through fog, slow down. That was an analogy Fed Chair Powell kept coming back to, and that's why I think he's looking more cautious than ever right now.
Yeah, that analogy stood out to me too, his fog analogy. We've all been there, that's for sure. When it comes to these rate cuts, I mean, is this going to be a major victory for consumers? Is that going to help people's pocketbooks?
Well, it depends if you're a borrower or a lender. So folks who are looking to buy, maybe for a mortgage, a car loan, something like that, your rates will be a little bit lower. For folks who are on fixed incomes, who've socked money away for retirement, and that's what they wanted to live on, they're going to have a little bit less income. The boring reality is a quarter of a percentage point fundamentally changes no one's lives. And I know we've talked about this before. The most important thing for monetary policy is for it to be approximately correct. If you're in the neighborhood of the right answer, things aren't going to go too wrong. Where you get in trouble is when you start to have crazy ideas, and where if the interest rate were 1, 2, or 3 percentage points away from where it really ought to be. I feel pretty confident right now saying we're roughly in the right neighborhood. We can have an argument whether we should be a little lower or a little higher. And so, not a big deal for any individual family. The really big deal is going to be, does the US economy avoid a recession? Or on the flip side, is AI somehow going to revolutionize our lives and make everything better?
How concerned are you about the blind spots we might have because of the shutdown and data not going out, and because obviously there's been the shakeup with the entity that is supposed to be putting out, like, the labor numbers, for example? Do we even clearly have a picture of the country's economic outlook?
Look, so the good news is that we have lots and lots of different sources of data that come from lots of different domains. For instance, the Federal Reserve collects data on industrial production, and the Federal Reserve is not part of the government shutdown right now. We have lots of private sector organizations who keep track of their prices through scanners and so on, and the Fed is very plugged into that. In fact, the pandemic in some sense was a dress rehearsal for what happens when you can't trust our official economic statistics. That said, Powell said it, and everyone on Wall Street says it. These things are a partial fix for when you're doing without, but there's nothing like the real thing. And the real thing is data from the Bureau of Labor Statistics and from the government, and we're getting none of that now. So we have two threats there that you mentioned, Anna, and they're both important. The first is, during the government shutdown, we're not going to be getting any more economic data. It could be that the economy has already fallen into a recession and we don't already know it. And the second thing has been Trump's attacks on the institutions, groups like the Bureau of Labor Statistics, which I still believe the numbers, and I urge folks at home to believe the numbers. But if those attacks were to continue, things get even darker again.
Justin Wolfers, as always, good to have you. Thank you.